Excess surplus insurance, better known as surplus lines insurance, is a line of insurance that exists to provide coverage for those risks that either standard or admitted insurers cannot or will not insure. It serves the needs of individuals and businesses that have unusual or hard to place risks that do not fit the strict underwriting rules of the standard market, which includes emerging industries, high hazard operations, properties that have incurred prior losses, or any other unique and unusual risks. Unlike standard insurers, surplus lines carriers are not licensed in each state in the same way admitted companies are, but that does not mean they operate in a Wild West. U.S. domiciled surplus lines insurers are regulated by their home state insurance department and must meet financial standards such as maintaining at least $15 million in policyholder surplus, while non-U.S. alien carriers must qualify for the NAIC's quarterly listing of alien insurers. International or alien surplus lines insurers are subject to additional safeguards before they are allowed to write business in the U.S. They generally must establish a U.S. trust fund for the benefit of American policyholders and meet eligibility criteria set out by the NAIC's International Insurers Department, which reevaluates listed companies on a regular basis. So where does the idea come from that excess surplus insurance is unregulated? The key difference is that regulatory focus shifts from the insurer itself to the transaction and to the licensed surplus lines broker who places the coverage. The Non-Admitted and Reinsurance Reform Act gives the insured home state the main authority over surplus lines transactions, including eligibility requirements, tax collection, and how the business must be reported. Licensed surplus lines brokers serve as the gatekeepers for this market. They must be specially licensed for surplus lines in the customer's home state, comply with that state's surplus lines law, and make required filings so that premium taxes are appropriately reported and paid to the state. Before placing business in the excess surplus lines insurance market, brokers generally are required to conduct a diligent search of the admitted market to determine whether any standard insurer will accept the risk. Most states require evidence that a specified number of admitted insurers rejected the risk, and regulators have the authority to audit those records as part of determining whether the surplus lines placement was properly made. States also monitor which surplus lines insurers can operate within their borders. Most keep lists of qualified surplus lines carriers, and before brokers can place businesses with them, companies must meet minimum financial and regulatory requirements, such as solvency and reporting standards. If something goes wrong in how the coverage is placed, state regulators have enforcement tools. Insurance departments can suspend or revoke a surplus lines broker's license for failing to follow rules on a diligent search, record keeping, or tax remittance, and can require corrective action or penalties when the laws are not followed. Policyholders also get certain disclosures so that they understand the differences between surplus lines and standard coverage. In general, surplus lines brokers must provide notices that the insurer is not licensed as an admitted carrier in the state, and the policy is not protected by the state's guarantee fund in case of insurer insolvency. Even with those differences, excess surplus insurance plays a crucial role in the entire insurance system. It fills gaps by covering risks that admitted carriers decline, such as new technology, high hazard operations, large or unusual construction projects, and properties or businesses exposed to catastrophes like hurricanes or wildfires. For many policyholders, E&S coverage is not about being huge or corporate, but about having a risk profile that just does not fit standard underwriting boxes. Small businesses with prior losses, startups using new business models, or owners of unique properties may all end up in the E&S market because it offers customized terms that the admitted market is not willing to provide. The surplus lines market has grown significantly as the economy and risk landscape have become more complex. Industry analyses show that demand for the specialty products and coverage for unconventional risks continues to rise, and the E&S segment has responded with innovative policy forms and flexible underwriting to keep the pace with emerging exposures. In practice, E&S insurance does not replace the standard market, it complements it. Standard insurers handle most day-to-day homogeneous risks. The E&S market provides a safety valve for the unusual or higher hazard exposures so that businesses and individuals are not left wholly uninsured when admitted carriers say no. Surplus lines insurance is thus regulated differently, not unregulated. Under the NRRA's home state oversight, NAIC standards for eligibility, state-maintained eligibility lists, licensing and enforcement for brokers, and required consumer notices, the E&S market blends flexibility with meaningful oversight in support of access to coverage when traditional options fall short.